Hi, this is Lara at Elliott Wave Stock Market with your end of the week video for the trading week ending Friday the 30th of September. Happy weekend everybody. This is going to be the last free video I do. Next week I'll be doing a video at the end of the week. It will be for members only, so thank you all for watching this week. I'm expecting Monday and Tuesday red daily candlesticks for the S&P to end at a target at 2137. After that, I'm expecting price to turn around and make a new high above 2179.58. Let's have a look at the main Elliott wave count at the weekly chart level. Both my Elliott wave counts see a cycle degree fourth wave over here and a cycle degree fifth wave underway. Cycle 5 must be a 5-wave structure. So far it's unfolding as an impulse and not an ending diagonal. So far within the impulse we have a first wave complete here, a second wave expanded flat complete here, a third wave most likely complete here. It did show stronger momentum and volume than the first wave, and so it looks okay as a third wave, but importantly it is shorter in length than the first wave. A fourth wave double combination complete here, and a fifth wave ending diagonal unfolding. Because the third wave is shorter than the first and a core Elliott wave rule states the third wave may not be the shortest, that limits the fifth wave to no longer than equality in length with the third at 2302.47. I have seen that rule misinterpreted fairly commonly as stating a third wave must be the longest. That is absolutely not what the rule states. The rules are black and white. A third wave may not be the shortest, which means here the fifth wave is limited. This third wave has a 0.618 Fibonacci ratio to this first wave. If that pattern repeats, the fifth wave will reach 0.618, the length of the third wave, at 2233. The fourth wave is very likely to be over here. I'll explain why when we get to the daily chart. If, in the very unlikely event it were to continue further sideways, it can't move into first wave price territory below 2111.05. Now I've seen this rule misinterpreted as well. The rule is very clear. No part of the fourth wave may overlap any part of the first wave, not the second wave. That's not what the rule states. The rule is clear. The rule says a fourth wave may not overlap first wave price territory. Here's an important way to interpret exactly what I mean. If, for example, this first wave had ended with a truncated fifth, then we read the first wave price territory as the extreme of its third wave. We don't read first wave as the end of a truncated fifth. We're talking about price territory. If the fourth wave is some kind of combination or triangle, then the deepest part of the fourth wave, the whole territory of the fourth wave, can't overlap first wave price territory, just to clear up any misunderstanding of that rule. Okay, let's have a look at the daily chart where third wave ends up here, and it did have stronger momentum and it had support from volume and it fits beautifully as a 5-wave impulse. So this is where the third wave ends. I expect this is where the fourth wave begins, and the fourth wave is a really common structure. It's a double combination. The first structure is a 335 expanded flat correction labelled intermediate wave W. The double is joined by a 3 in the opposite direction labelled X, and the second structure is a 535 zigzag labelled intermediate wave Y. Double combinations are very common structures. Triples are very rare indeed. Now here is just a warning for those who are new to viewing this YouTube channel this week. If you're viewing other Elliott wave work online, this is the most common misuse of Elliott wave labelling that I see actually really often. If you see anything purporting or calling itself to be Elliott wave, which has plenty of labelling with W, X, Y, X, and Z, if you see any Z labels on such an Elliott wave count, be highly suspicious. It's probably not Elliott wave. Triples are very rare structures. In my over 8 years of daily Elliott wave analysis of multiple markets, and I am a CMT, so I do know what I'm doing, I have seen probably only about 3 or 4 triples, triple zigzags or triple combinations, and so they're really rare structures. So if you see anything with that labelling with Z waves labelled, be highly suspicious. It probably isn't following Elliott wave rules, maybe ignoring plenty of guidelines, certainly probably would be, and it would have no predictive value whatsoever. Don't waste your time on it. This is a double combination, but the only thing that's atypical about it is the second structure in the double has ended reasonably beyond the end of the first. Most of it moves sideways, and the X wave does make a new price extreme beyond the start of the W wave. There's no rule stating an X wave can't do that, and X waves and combinations can behave just like B waves of expanded flats. They may make new price extremes beyond the start of the W wave, but the thing that's not quite normal here is intermediate Y moves beyond the end of W. It mostly has a sideways look, but Y ends with a downward look to it. The purpose of the second structure in a double combination is to take up time and move price sideways. To achieve that purpose, it usually ends close to the same level as the first. This one doesn't, but the difference isn't so huge. It does still look reasonably acceptable, and that's how the subdivisions fit best. When primary wave 5 began, I had 2 hourly wave counts for it because there are 2 possible structures for a fifth wave, either a simple impulse, which is most common, so that was my main wave count, or an ending diagonal. That's less common, still a reasonably common structure, particularly contracting diagonals, but they're not as common as impulses, so that was my alternate wave count. The main wave count was invalidated with these 3 days of downward movement, leaving only one structure left, possibly for primary wave 5. An ending diagonal. An ending diagonal requires all of the subwaves to subdivide as zigzags, so that's why you see this labelled ABC. It's a zigzag within an ending diagonal. We need a zigzag to complete downward now for the second wave, which may not move beyond the start of the first wave, below 2119.12. These invalidation points for those rules for Elliott wave are absolutely black and white. No part of intermediate wave 2 may move beyond the start of 1 by any amount at any time frame. Intermediate wave 2 must subdivide as a zigzag, and it's very likely to end in 2 more days. Intermediate wave 1 lasts a Fibonacci 8 days or sessions. Intermediate wave 2 has so far lasted 6, so if it continues for only 2 more, it would have perfect proportion. It would be even in duration with intermediate wave 1, and that would give the wave count a really good look. Let's have a look at how it's done. Actually, just before we go there, when it's complete, I'll be expecting intermediate wave 3 to move beyond the end of 1, meeting that Elliott wave rule that states a third wave within a diagonal must move beyond the end of the first wave. And so that's why after 2 days of downward movement, I'm expecting a turn and overall upward movement to move above 2179. Let's have a look now at the hourly chart where intermediate wave 1 ends here. This is where intermediate wave 1 ends and intermediate wave 2 begins. It must subdivide as an impulse. So far we have 5, 3, and now I'd expect a 5 down. I had prematurely labelled minor wave B over here as a relatively deep but relatively brief zigzag. I had expected that this was where C began, but that was invalidated on Friday at the end of the session with a slight new high. Minor wave B must have continued further sideways. I've labelled this structure a double zigzag because that's how it subdivides. You can't label this A, B, C as a flat correction because what would be the B wave would be less than 90% of what would be the A wave. This is 0.88, the length of this prior wave up, and so that Elliott wave rule for a flat correction is not met. This is not a flat correction. That tells us we should expect this wave up should be a 3 wave structure, not a 5, which tells us it's very likely to be over here. Minor wave B subdivides as a double zigzag. They're relatively common structures. Here we have a 5, 3, 5, the first zigzag in the double. It's joined by a 3 in the opposite direction. This didn't continue down further to be a 5. It ended here as a 3. And here we have another 5, 3, 5 zigzag, most likely complete here. If minor wave B moves any higher, it can't move beyond the start of A above 2179.58. If minor B is over here and minor C begins, then at 2137 minor C would reach equality in length with minor wave A. That's the most common ratio between A and C waves within zigzags, and so that has a good probability. It would also take intermediate wave down to within the normal range. A normal range for second and fourth waves is between 0.66 to 0.81, the length of the prior first or third wave, giving intermediate 2 a range from 2140 to 2131. And so this target has a very good probability. I'm not going to go over the alternate. If you want to see an explanation of that, look at the last video. Let's jump straight into classic technical analysis at the weekly chart level. We have an inside week, it's got a lower high and a higher low, it's closed green, it's got a long upper wick. The colour and the long lower wick. The colour and the wick are bullish, as is the support from volume, and so it would be quite reasonable to expect next week to continue more upward movement. Except on balance volume is coming up to find resistance, so we may get a downward reaction here from price, at least short term. That fits quite nicely with the Elliott wave count. This trend line from on balance volume is tested once at least. You could possibly consider this a test as well. So once or maybe twice before. It's not too long held. It's reasonably long held and it's got a reasonable slope. So it's not got strong technical significance. It might provide some resistance and halt the rise in price. We may see a reaction here. There is some divergence at the end of this week between this point and this point in on balance volume, and this point in price. Price has made a lower high, but on balance volume has made a higher high. That tells us that this upward movement from price is internally weak in terms of volume. Now that divergence can absolutely not tell us we should or must get a change in downward movement here. It only tells us to be wary and suspicious of this upward movement from price. And I have recently found that divergence at the long-term divergence between price and on-balance volume, and even price and RSI at the daily, weekly and monthly chart level is currently not particularly reliable, or at least it's been followed by a continued movement from price upward after divergence told us there was weakness. Now from an Elliott wave perspective, I'm expecting that this upward movement is a fifth wave at 2 very large degrees, and so I would be expecting to see some continued persistence and deepening weakness in upward movement, and we are seeing more weakness. RSI is not yet extreme at the weekly chart level and exhibits no divergence at the weekly chart level to indicate weakness with price. There is still further room for price to rise. At the daily chart level, let's make that a lot bigger. At the daily chart level, Friday closed with a green candlestick with a long upper wick. The wick is slightly bearish, the colour is bullish, and it's got good support from volume. That's quite bullish. This is quite strong volume, stronger than most of all these days except for this one. Now it would be quite reasonable to expect a continuation of upward movement, but that's not what I'm seeing from a couple of other signals, and so it's not, well, nothing is ever absolutely certain in technical analysis, but I'm not going to conclude that we're going to see more upward movement Monday, Tuesday. But there is a little bit of doubt on my prediction for downward movement Monday, Tuesday, because we are seeing quite good support from volume for this upward movement. We may see price find some resistance about this resistance line, which has previously offered good resistance and then support several times, and here again. So we may see a reaction around 2175 about here. This market is consolidating. It started a sideways movement back about here, and it's overall fluctuating from resistance to support and back again. ADX is declining. It's telling us the market is not trending. ATR is overall still mostly flat, still not really starting to show a good increase yet, overall flat. And Bollinger Bands are very slightly contracting and still mostly flat to contracting. So those three indicators all together are telling us that this market is not trending. And so we can reasonably expect overall a continuation of an upward swing only to end when price gets to about 2190 and stochastics reaches overbought, except that approach isn't really working very well at the moment either. We had stochastics not quite reach overbought, but price did reach resistance about very close to 2190 here, and that was the end of the upward swing. We got a downward swing, price reached support, stochastics didn't quite manage to reach into oversold, so I think we need to narrow our expectations for stochastics, and so it would be quite reasonable to expect an end to the upward swing about here, with price again close to resistance at 2175 and stochastics close to overbought. But we could certainly allow for more upward movement for price to find resistance at the next line and for stochastics to move properly into overbought territory. Let's have a look at VIX and the AD line, because there's something quite exciting at the end of the week. I know that's really geeky, but I think this is quite exciting. This is one signal that has been working quite nicely lately. Very short-term divergence between inverted VIX and price, and the AD line and price has been working quite nicely, mostly reliably, to tell us the direction for price for the following 1 or 2 days. Now, this doesn't always work. It is not 100% reliable. Nothing in technical analysis is 100% certain. If something was 100% certain, we'd all be very wealthy indeed. But that is not how markets behave, and that is not how technical analysis works. We have to work with a balance of probabilities and use the evidence in front of us to make a judgment on that balance of what price is going to do next. Here we have short-term bearish divergence between the inverted VIX line and price. Price for Friday made a slightly higher high. Inverted VIX made a substantially lower high. And so this tells us that there is weakness in this upward movement for Friday, and so it tells us we are very likely, not certain, but likely to see 1 or 2 days of downward movement from price to resolve that divergence. And that fits very neatly indeed with the 2 days expected of downward movement from the Elliott wave count. Now, this does not make any comment whatsoever on how far price is going to go. It only tells us what direction price is likely to move in for 1 or 2 days only. We also have the same negative bearish divergence between the AD line with a lower high and price with a higher high. Again, there is a lack of breadth to this rise in price for Friday, and so we could reasonably expect 1 or 2 days of downward movement. And again, this also makes absolutely no comment on how far price is likely to go, only the direction for 1 or 2 days. It's absolutely of no use at all in helping to set targets. For that, I use Elliott wave. That's all for me at the end of the week. I hope that new viewers have found this week of free videos useful and educational for you, and I hope to see you all soon in our membership area.